All right, so let's talk about market making as a strategy. Market making is adding liquidity to the order book. So, most good exchanges need market makers. So, you'll notice that Poloniex, for example, when they list a new coin, they tend to have really, really high prices on price discovery because they have good market makers who attract traders over, and that adds liquidity and it attracts traders to trade. So their volume tends to be a lot higher than the other altcoin exchanges. So because they know how to do it right, they've taken the lead out of all the other altcoin exchanges. Now, a lot of crypto traders seem to think that market makers manipulate the price, that they'll pump or dump the price. But there's a difference between a market maker and a market mover, right? Market maker only adds liquidity to the order books. The instant you start taking orders off the book, by technical definition, you're no longer a market maker, you're a market mover, and there's a difference between that. And sometimes you could have a hybrid approach where someone will do both of those things. They might market make and they might push the markets around as well. But we're just going to look at pure market making. So it usually requires deep pockets because you have to add liquidity to the book and you have to be able to cost average down in case the markets move against you, and you have to be able to deal with that, right? So it's also important to manage risk that you don't use leverage, right? And oftentimes, like if you're going to do true market making, you're not even going to set stops. So it's more of a cost averaging down strategy. Don't use leverage because for a couple of reasons. A, you're going to be paying fees. And as a market maker, you need to be patient. But B, you could also get liquidated, right? There's a chance of liquidation. That's not good risk management. Now, the biggest risk as a market maker is counterparty risk. Obviously, if you got to keep a lot of money on an exchange, then if the exchange gets hacked or runs away with an exit scam or something like that, then you could lose everything. And market makers in the past have lost everything when exchanges went bust. And if you are going to market make and you're okay with the counterparty risk and you've got deep pockets, then work out a deal with the exchange ahead of time, or choose one that automatically pays market makers, such as BitMEX. So let's go into that. So let's say you're someone who doesn't have deep pockets but wants to market make anyways. One really great place where you can do this is BitMEX because you can have contracts as low as $1. So even if you don't have deep pockets, you can still stack the order books on both sides. And the great thing about BitMEX is that they actually pay market makers fees. So what they do is they charge fees to market takers, people who take orders off the book, and they pay fees to market makers. So that's a fairly good system. And a lot of market makers, you'll notice on these order books, actually use automated trading, right? So they'll have algorithms that'll watch China and be able to stack the order book and move orders around and stuff like that. One very simple initial strategy of market making is scalping the spread. So that's when you stack order books on both sides. Sometimes you'll try to trade on exchange and you'll stack an order and then a bot will automatically put an order ahead of yours. And you'll see this happening a lot of times on exchanges with market maker bots. But you can just scalp the spread back and forth. And the benefit of a strategy like this is it's actually good strategy when the markets are really flat and stable, right? It's ideal for that kind of market. So even if you have a flat, stable market, you could just continuously scalp the spread over and over and over again. But it works much better if you have an automated algorithm to be able to do that for you. So let me give you a simple example of a market making strategy. So let's look at Ethereum as an example. Now, this is a strategy using Fibonacci retracements where you essentially start at the bottom of the trend, you measure the entire space of the trend, and you just use fibs as general areas of support and resistance, and to be able to price out your orders. So this is a cost averaging down strategy. So if you were to scalp the spread here, which is kind of mid-range, 50% of the trend, you could see it's right halfway. You could scalp the spread with lower orders, right? So let's say 10% of your capital goes towards buying, 10% goes towards selling. Ideally, you have a combination, equal share of Bitcoin and Bitcoin and Ethereum to be able to sell back and forth. And if the market's flat, so you just keep on scalping with smaller position size. But let's say the market moves against you and it starts to dump, right? Then what you could do is you stack orders. And this 10% doesn't necessarily need to be right on the line. It could be stacking 10% of your capital all between this fib level to this fib level, stacking 20%, between here and here, and so on and so forth. So you could just kind of cost average down and sell cost average up by selling as well. And these are fluid and dynamic, so this isn't going to stay static. So obviously, if you have 10% here and the market dumps, and then you have 20% and the market dumps some more, and then finally you cost average down, but it has a play or bounce play, you can stack the sell orders of what you accumulated up on the other side so that it starts to buy into your sell orders and reduce your risk exposure, right? And actually be able to lock in some profit, because when you cost average down, usually when the markets bounce, you can find yourself in profit. Like it won't take much to get back into the profit zone, right? So you can do this for any altcoin market. Obviously, the less liquid altcoin markets, you can actually have smaller trading capital market make, but they also come with more risk. If a whale dumps, then you could get wrecked on slippage and things like that. So, I would always practice first and experiment. And ideally, you'd have some kind of automated trading bot and algorithm to be able to maximize this profit potential. Now, there are various different market making strategies. Obviously, if you were to do like a Bitcoin market making strategy, you'd want your bot to pay attention and track China. So if the markets were dumping, for example, then you'd want to be able to pull your orders immediately and stack them lower. Sometimes you can have a market making strategy that trades volatility. When there's max volatility, you can stack low orders, catch a bounce play on the books, and then sell, catch a dip on the books and sell on the bounce play. So you don't have to stack orders all the way down. Another market making strategy is you just keep low orders on the books and you catch these big kind of washouts, right? So, obviously if the market's here and you've got orders stacked down here, then they sell into your orders, it bounces, you automatically stack some orders 2 fib levels up. So you could do that and just kind of play the fib levels, almost like strings of an instrument type of thing. And, especially when the markets are very volatile, right? So this went a bunch of fib levels up and then it goes 4 fib levels down. So you could, stack orders down here and then sell as it bounces, and so on and so forth. So that concludes this section on market making. I'll see you in the next section. Cheers.